Imagine for a second that you're tracking your own career trajectory, right? Let's say you are working way fewer hours this year than you did last year.
Sounds pretty nice, honestly.
Right. I mean, you're producing significantly less output. You're closing fewer deals, and you're generally just moving less volume across your desk.
Okay, so a bad year on paper.
Exactly.
Yeah.
But then when you get your paycheck, it hasn't just stayed the same. It is inexplicably jumped by 26%.
Oh, wow. Yeah, that math does not add up at all.
It doesn't. But that is exactly the reality-bending math that Masco Corporation, ticker symbol MAS, just reported to Wall Street.
Yeah, it's a wild scenario.
So today, we're taking a deep dive into this. We need to find out how a massive plumbing and paint company sold fewer physical products, but somehow printed a towering pile of cash.
Right, because that's the real misdemeanor.
It is. And we're doing what we do best here. We're bringing you a data-forward, highly opinionated, and actionable analysis. We want to cut straight through all that dense corporate jargon and give you the vital takeaways.
Because, I mean, when you look at the headline numbers for Masco in this second quarter of 2026, they present this massive, glaring disconnect.
Oh, 100%.
And, in the investing world, whenever you see a disconnect between the story a company is telling with its profits and the reality of its actual top-line sales.
You have to stop and interrogate the data.
Exactly. You have to understand the actual structural health of the company. You have to find out what specific mechanical levers management pulled to, create that disconnect.
So let's just jump right into the deep end with those headline numbers, because on paper, they are absolute showstoppers.
They really are. They jump right off the page.
Right. Like if you were a retail investor just glancing at your brokerage app and you see the alert flash across your screen, you would think Masco just executed the most flawless quarter in the history of home improvement.
You'd think they were selling paint made of gold. Yeah.
So I want to emphasize these profitability metrics because they are staggering. Earnings per share, or EPS, came in at $1.64.
Which is up an astonishing 26% year over year.
Yeah, 26%. And their operating profit hit $482 million. It's a 17% increase.
Right.
But the kicker is the operating margins, which, is the percentage of revenue they keep as profit after paying the direct costs of making their products. That expanded to a very healthy 24.2%.
Yeah, and we really need to pause on that 24% number for a second.
Why is that so crazy?
Because for a company manufacturing heavy physical goods like literally brass faucets and heavy gallons of paint, a 24% operating margin is almost bordering on software company territory.
Oh, wow. Yeah, I guess when you put it like that, it's insanely high.
It is incredibly high for this sector. Those are the exact kinds of numbers that trigger automated buying algorithms on Wall Street.
Oh, right. The bots just see margin expansion and buy.
Exactly. It signals a highly efficient, highly optimized operation that is squeezing maximum value out of every single transaction. But then...
That was a but.
Right. But then as an analyst, you have to look one line higher on the income statement. You have to look at the revenue reality.
The actual sales.
Yes. Because while the profits were skyrocketing to the moon, the actual top-line net sales, the physical volume of product they actually moved out the warehouse doors, decreased by 3% in the second quarter.
And right there, that is the glitch in the matrix. That's the mystery we have to solve today.
Yeah, it really doesn't make intuitive sense.
It doesn't. How do you sell 3% less plumbing and paint, but generate 26% more earnings per share? Is this some Wall Street financial alchemy?
It certainly looks like it.
Because you can't just wish a 26% profit growth into existence when fewer people are actually, walking into a store and buying your showers.
No, you absolutely cannot do it through normal, organic, operational growth.
What?
You need a catalyst.
Okay, so what was the catalyst? What's the magic trick?
The magic trick here, the thing that made those margins look so spectacular, was heavily driven by a massive one-time structural windfall.
A windfall. Like a tax break or something.
Sort of. During this quarter, Masco received a net benefit of $95 million from what are known as IEPA tariff refunds.
Wait, $95 million? Just a one-time refund?
Yep. The government essentially cut them a check for past overpayments on trade tariffs. And when you strip that $95 million government refund out of their quarterly mass, their underlying sales and operational health were basically flat compared to last year.
Wow. Okay, so wait, is it brilliant financial management or is it a massive red flag?
That is the exact tension every analyst is grappling with right now.
Because if I'm an investor,
Yeah.
right, I want a company that grows because consumers absolutely love their products and they're buying them in droves.
Naturally.
I don't want a company that only grows because they got a lucky government refund check and used it to engineer their spreadsheet. Doesn't this feel like they're using an accounting windfall to mask a core business that is actually shrinking?
It's a completely valid concern. I mean, if you view a company strictly as a vehicle for moving physical units, more faucets sold this year than last year, then this quarter is a huge disappointment. Volume is definitively down.
Right.
But if you view a company as a vehicle for generating return on capital, then what Masco's management team did with this windfall is actually quite strategic.
What do? Did they just pocket it?
No, they didn't just let the money sit in a low-yield bank account. They weaponized it. But before we get into exactly how they spent that cash, we really need to look at why the core business is shrinking in the first place.
Okay, yeah, we need to look under the hood.
Exactly. We have to look at their two massive segments to understand what is actually happening to the consumer.
Right, so let's pull the engine apart. Masco basically has two massive pistons firing. You have plumbing products, which includes powerhouse brands like Delta Faucets, Hansgrohe showers, and Watkins wellness spas.
Very premium brands.
Yeah, heavily premium. And then you have decorative architectural products, which is heavily dominated by Burr Paint. The brand you see stacked ceiling high in every Home Depot.
You literally can't walk into a Home Depot without seeing it.
Exactly. So let's start on the plumbing side, which overall was down 3% in local currency.
Right. And when we break that 3% decline down geographically, we see vastly different macroeconomic forces at play.
Okay, so let's look at North America first.
Yeah, North America is interesting because plumbing sales there dropped by a rather sharp 6%.
6% is pretty steep for a core market.
It is. Now, management was quick to point out that this was partially due to a very tough year-over-year comparison. The second quarter of 2025 was a particularly strong quarter for them.
Oh, I see. So trying to beat those numbers was always going to be an uphill battle.
Exactly.
It's like the curse of high expectations, If you hit a grand slam last year, hitting a solid double this year feels like a letdown to Wall Street, even if it's still really good contact.
That is a perfect analogy. But looking at the transcript, it wasn't just the tough comparison holding them back.
Right, there was something else.
Yes. There was a very specific and highly debated drag on that North American revenue number. Management admitted that more than half of that 6% year-over-year drop was due to what they vaguely termed targeted strategic investments to support long-term growth.
Targeted strategic investments.
Yeah.
Wow, that is peak corporate jargon right there.
It really is. It tells you almost nothing.
Yeah, and you could tell reading the transcript that the Wall Street analysts were getting incredibly frustrated with that phrase. I mean, you had guys from Barclays, Wells Fargo, Truist, and Evercore essentially cornering the CEO, John Nudi.
They were not letting it go.
No. They were practically begging him to explain what these secret investments actually were. They kept asking it in 5 different ways, trying to pry the details out of him.
And you have to understand why the analysts were like bloodhounds on this issue.
Why? Why did they care so much about that specific phrase?
Because of where these so-called investments showed up on the balance sheet.
Okay, explain that.
Well, normally when a company talks about making a strategic investment, they are talking about capital expenditures. Building a new manufacturing plant, upgrading software, or hiring 1,000 new R&D engineers.
Right, things you spend money on.
Exactly. And those things show up as operating expenses. But Masco's investments actually reduce their reported net sales.
Oh. Which means it's a contra revenue item.
Bingo.
So if it lowers your net sales directly, it means you are giving up top line dollars. Like you are doing something involving customer pricing, heavy retail promotions, or perhaps paying aggressive rebates to your wholesale distributors.
Or retail partners like Home Depot, yeah.
Right, to secure premium shelf space.
Exactly. The implication is that they are essentially buying market share or securing retail placement by sacrificing immediate top-line revenue.
So they're taking a hit on price to move product or get better positioning.
That's what it looks like. But when asked point blank if this involved stepping up consumer promotions like, say, running a 20% off all Delta faucets, Sale Nudi was incredibly guarded.
What did he say?
He explicitly said, and I quote, particularly when it comes to promo. That's not necessarily the focus, and certainly we're trying to invest for the longer term.
Wow, okay. It felt very much like a poker game on that call. He cited competitive reasons for keeping the details close to his chest.
He did. He just kept reverting to the talking points from their May investor day.
Just talking about like leveraging industry-leading brands and enhancing operational excellence.
Yep. Word salad.
It was basically a corporate way of saying, trust us. We took some of that tariff refund money. We used it to buy a massive advantage in the market that will pay off later, but we are absolutely not going to tell our competitors what our new weapon is.
And this is exactly where the tariff refund becomes the crucial puzzle piece.
Okay, how so?
Well, when a company gets a sudden $95 million windfall, they have a choice. They can let it all flow straight to the bottom line, making the quarter's profits look astronomical.
Which juices the stock price for the executive team's bonuses, naturally.
Or they can use that temporary cushion to quietly fund aggressive strategic moves that would normally terrify shareholders by compressing margins.
Oh, I see.
Masco chose the latter. They basically used the tariff refund as a smokescreen.
That's brilliant, actually.
It is. The refund kept the overall margins looking historically high at 24%, which allowed them to quietly absorb the cost of these competitive investments in North America without triggering a panic sell-off.
Wow. Okay, so North America is a story of tough comparisons and secret defensive maneuvering. But plumbing isn't just an American story for them. What happened overseas?
International plumbing was actually the bright spot of the entire report. Yeah, sales were up 4% in local currency. And the geographical divergence here is totally fascinating. The growth was heavily driven by the European markets, specifically Germany.
Germany?
That's surprising. Right. Masco owns Hansgrohe, which is a very premium, luxury German plumbing brand celebrating its 125th anniversary. And despite the broader macroeconomic gloom we constantly read about in Europe right now, that high-end brand performed exceptionally well.
Which is fascinating because, I mean, you look at the energy crisis hangover in Germany, you look at their industrial slowdown, and you definitely wouldn't expect a premium showerhead company to be thriving.
No, you wouldn't.
But it kind of proves that true luxury brands often float above the everyday economic weather.
They absolutely do. But unfortunately, that European strength had to work overtime because it was partially offset by a massive anchor dragging them down in Asia.
And that anchor is the Chinese real estate market, I'm guessing.
You guessed it.
Yeah. We have been watching the slow motion collapse of the Chinese property sector for years now, going all the way back to the Evergrande crisis.
Exactly. And the plumbing industry is inextricably linked to new housing starts.
Of course. No new houses, no new toilets.
Exactly. If massive Chinese property developers are defaulting on their debt and halting construction on half-built apartment towers in Tier 2 cities, those developers are no longer placing orders for 5,000 faucets at a time. The pipeline dries up completely.
Yeah, that makes sense. So Masco's plumbing division is balancing on a knife's edge. Strong luxury demand in Germany is fighting against a structural real estate depression in China, while North America undergoes a strategic reinvention.
That perfectly frames the complexity of a multinational supply chain. It's a huge balancing act.
So let's pivot to the other side of Masco's business.
Yeah.
The decorative architectural segment.
The paint.
Right, heavily reliant on burr paint. Sales here decreased by 4%. And I have to say, the details buried in this 4% drop provide one of the most crystal clear pictures of the American consumer I have seen all earnings season.
I totally agree. It is a phenomenal macroeconomic indicator.
Because it's not just a flat 4% drop.
No. Within that 4% overall drop, management revealed a stark bifurcated reality. Pro paint sales, meaning the massive buckets of paint sold to professional contractors, home builders, and professional painters, were actually up mid-single digits.
Up. The pros are buying more paint.
Exactly. But DIY paint, the gallon of paint you or I might buy on a Saturday morning for a weekend project, was down high single digits.
This is the ultimate tale of two economies. I mean, it is the contractor versus the weekend warrior.
It really is.
The professional crews are fully booked. They have a backlog of major renovation projects. They have the capital, and they are steadily buying materials to get the job done.
Because it's their livelihood.
Right. But the everyday DIY consumer,
Yeah.
they were sitting on the couch, staring at their walls, and deciding to, just live with the old color for another year.
And if we extrapolate this to the broader economy, it speaks volumes about the exhaustion of the middle class right now.
How so?
Well, professional projects, like a full kitchen remodel or a major addition, they're usually planned months or even years in advance. They are often funded by home equity lines of credit or established savings from higher income households.
Right. Big structural money.
Exactly. The DIY project, however, is deeply sensitive to immediate cash flow and consumer confidence.
It's impulsive.
Yes. When a family is feeling the compounding effects of 3 years of inflation at the grocery store and the gas pump, the impulse decision to spend $300 on paint and supplies to redo the guest bedroom, that gets completely scrapped.
Yeah. The CEO, John Nudi, actually used a specific term during the Q&A that economists love. He called it a K-shaped economy.
Ah, yes, the K-shape.
Let's unpack what that means for the listener, because it is crucial to understanding consumer stocks right now.
Sure, it's a great concept.
So in a K-shaped economy, different demographics diverge completely, just like the arms of the letter K. The top arm is angling upward. That represents the asset owners, the wealthy, the people whose stock portfolios and home values have insulated them from daily inflation.
The ones hiring the pros.
Exactly. They are still spending aggressively. The bottom arm of the K is angling downward. That represents the middle and lower income consumers whose wages haven't kept pace with the rising cost of basic necessities.
The DIYers.
Right. They are feeling a severe squeeze and are pulling back on everything discretionary.
And Masco's portfolio is a perfect microcosm of that K-shape. You have the DIY paint consumer struggling down at the bottom of the K, but then look at a very specific niche within their plumbing segment, Watkins Wellness.
Oh, right. The spas.
Yeah, this is the division that manufactures premium spas, hot tubs, and saunas. On the call, Nudi noted that their spa business is holding up beautifully, and their sauna business is actually growing at a rapid double-digit rate.
Which sounds completely counterintuitive. Like if people can't afford a $40 can of paint, how on earth are they buying a $5,000 home sauna?
Because it is a completely different consumer.
Right.
The sauna buyer lives on the upper arm of the K. The upper income consumer is not worried about the price of eggs. They are focused on premium health, wellness, and turning their home into a private sanctuary.
They have the discretionary capital to spend, and they are spending it.
Exactly. While the middle-class homeowner is delaying basic maintenance.
It is a wild juxtaposition. Now, before we leave the paint segment, there was one specific mechanical headwind they mentioned that we should probably clarify.
Right, the shelf space issue.
Yeah, management noted that the DIY paint drop was exacerbated by a customer transition of our primer and applicator business.
Yes. And in the world of retail manufacturing, shelf space is everything. A SKU or stock keeping unit represents a specific product on a shelf.
Right.
When you lose the placement for a specific product line, like a certain type of primer or a specific paint roller at a massive retailer like Home Depot, it creates an immediate mechanical drag on your year-over-year revenue comparisons.
You literally just don't have that footprint anymore.
Exactly. You are literally missing a chunk of sales you had last year. Management expects to fully cycle past this anniversary in the second half of the year, meaning the comparison will normalize, but it definitely added weight to this quarter's high single-digit DIY drop.
So if we pull back and look at the whole picture so far, people are buying fewer physical units of plumbing in America. China is a dead zone for new builds, and the American middle-class DIYer is completely tapped out.
It sounds pretty bleak when you list it all out like that.
It does. The volume is shrinking across the board. Which brings us to the most critical question for you, the retail investor listening to this.
Yeah.
If the core business is facing this much volume pressure, why is the stock a buy? How is management engineering success out of this environment?
This is where we transition from looking at Masco as a manufacturer to looking at Masco as a financial allocator.
Okay, lay on us.
And this management team is proving to be absolute masters of capital allocation. They did not just take that $95 million tariff refund and use it to throw a massive corporate party.
Though I'm sure they thought about it.
Maybe for a second. But no, they executed what I like to call a windfall strategy. They reinvested a portion into those secret competitive maneuvers in the plumbing space, but the vast majority of their excess cash flow was deployed in the most aggressive way possible to support the stock price.
Buybacks.
Yes. They bought back shares.
And not just a little bit of stock. In the second quarter alone, Masco bought back $390 million worth of their own shares.
Which is a staggering sum for a 90-day period.
Absolutely.
And to execute this, they utilized an accelerated share repurchase, or ASR, program.
Okay, an ASR. Explain how that works, because it's not just buying stocks on an app.
No, it's a highly specialized financial maneuver. Instead of just buying shares slowly on the open market every day, A company signs a contract with a major investment bank.
Like a Goldman Sachs or someone.
Right. The company hands over a massive pile of cash up front to the bank, and the investment bank immediately borrows millions of shares from institutional investors and hands them over to the company to be retired.
Wow, okay. Instant gratification.
Exactly. The bank then slowly buys shares on the open market over the next few months to replace what they borrowed. It allows a company to instantly shrink its share count by a massive amount, signaling extreme confidence to the market.
To really visualize why stock buybacks matter so much, let's get away from the overused textbook analogies. Imagine you are an investor in a massive 1,000-room luxury hotel.
Okay, I like where this is going.
Right, so the hotel is doing okay, but it's an economic downturn, so overall bookings are slightly down. The total revenue the hotel brings in has actually shrunk by 3%.
Right, mirroring Masco's 3% sales drop.
Exactly. But the management team has a ton of cash in the vault. So instead of trying to build more rooms in a bad economy, they use that cash to permanently buy out and demolish 200 of the rooms.
Bit extreme for a hotel, but it tracks.
Bear with me. So now the hotel only has 800 rooms. The total revenue of the building is still down, but the revenue per available room has suddenly skyrocketed.
Right, because the pie is the same size, but there are way fewer slices.
Exactly. The business itself didn't actually grow. They just aggressively shrunk the physical footprint of the equity to make the underlying math look incredibly profitable for the remaining owners.
That is the perfect way to understand EPS, earnings per share. By aggressively retiring millions of shares, they are artificially boosting the earnings attached to every single share that is left.
Right.
This is the exact mechanism that explains our opening mystery.
The tariff refund boosted the total earnings pool, and the ASR buyback shrunk the divisor, the number of shares.
Exactly. When you increase the numerator and shrink the denominator, your EPS explodes upwards by 26%, even if your total sales dropped 3%.
It's wild. It is a highly defensive but incredibly powerful tool for generating shareholder value in a stagnant growth environment.
It really is.
But I have to push back here again. I mean, if I'm an investor holding Masco for its next decade, do I really want them using $1 billion to buy back stock? Shouldn't they be using that money for R&D?
That's the classic debate.
Right. Like, shouldn't they be inventing the next revolutionary smart home water system or a paint that never chips rather than just playing financial games to inflate their EPS?
It's the classic debate of capital allocation, but you have to look at the macroeconomic reality.
Which is pretty soft right now.
Very soft. If the consumer is tapped out, and housing turnover is at historic lows because everyone is trapped in their 3% mortgages.
Ugh, don't remind me.
Right. The return on investment for building a massive new factory right now is likely negative. Management is looking at the landscape and deciding that the absolute best return they can get for their cash is investing in themselves at the current valuation.
That makes sense.
And to double down on that belief, CFO Rick Westenberg announced they are raising their 2026 target for share repurchases and acquisitions from $800 million to a massive $1 billion. $1
billion.
Yeah.
And they can afford to do that because of the specific nature of their balance sheet, right?
Exactly. We need to talk about their leverage. Right now, their gross debt to EBITDA is sitting at roughly 2.1 times.
Okay, let's explain why that specific metric matters. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically a proxy for the raw cash a business generates from its operations.
It's the cash engine.
Right. The debt to EBITDA ratio tells you how many years it would take the company to pay off all its debt if it used every single penny of its operational cash flow.
And in the heavy manufacturing sector, anything under a 3.0 is generally considered a fortress balance sheet.
2.1 is incredibly safe then.
Very safe. It means they aren't choking on high-interest debt payments. Because their debt load is so manageable and their business converts a massive percentage of earnings directly into free cash flow, they have the financial firepower to just drop $1 billion on buybacks without breaking a sweat.
So we have solved the Q2 mystery. The volume is soft, the consumer is fractured, but the financial engineering and capital allocation are, frankly, world-class.
They are playing the game beautifully.
Which brings us to the future. How is management viewing the rest of 2026, knowing they are carrying the weight of a tapped-out middle class and a struggling Chinese economy?
The updated guidance is where the math really crystallizes, and it reviews exactly how management is managing expectations.
What did they change?
They raised their full year 2026 EPS guidance to a range of $4.40 to $4.60.
That is a very solid bump up from their prior expectation of $4.10 to $4.30.
It is. They also raised their overall operating margin expectations for the year to approximately 18%. Up from 17%.
Okay, so they raised the earnings forecast and they raised the margin forecast. But here is the kicker, the detail that proves exactly what is happening. They kept their full year sales expectations exactly the same.
Yep.
They still expect overall sales to be up only low single digits for the entire year. If sales aren't growing any faster than they originally modeled, why are the earnings going up?
Because the EPS raise is an accounting reflection of the past, not a projection of accelerating business in the future.
Right.
Management is essentially taking that one-time tariff refund they already received and simply baking it into the annual forecast. The core underlying business expectations haven't changed by a single dollar.
Let's actually break down the exact math on that refund because an analyst from UBS, John Lovallo, caught a discrepancy on the call that was fascinating.
Oh, this was a great catch.
It really was. So in Q2, Masco reported a $95 million net benefit from the tariff refund. But when the CFO updated the full year guidance, he stated that the total full year benefit of the refund would only be $85 million.
Right.
Lovallo essentially keyed in on this and asked, wait a minute, you got $95 million in cash. Why are you only projecting an $85 million benefit for the year?
Yeah.
Where did the other $10 million evaporate to?
It was a very sharp catch by the analyst. Rick Westenberg had to explain the nuances of corporate accounting conventions regarding employee incentive compensation.
The bonuses.
Yes. Here's how it works. When a corporation experiences a massive, unexpected profit windfall in a single quarter, it automatically triggers higher performance metrics, which in turn triggers higher bonus accruals for management and employees.
Makes sense. Everyone gets a piece of the pie.
Right. However, strict accounting rules dictate that you cannot recognize the entire expense of that year-end incentive compensation in a single quarter if the performance metric applies to the full year.
So they have to spread out the pain.
Exactly. So Masco booked the entire $95 million benefit in Q2, but they have to amortize or spread out the remaining $10 million in employee bonus expenses over the third and fourth quarters.
So the net benefit to the company for the entire year after paying out the extra bonuses triggered by the windfall is $85 million.
Spot on.
And if you take that $85 million and divide it across their roughly 200 million outstanding shares, you get approximately 42 cents per share in extra profit.
Yeah, the math checks out.
Now look at their EPS guidance raise. They raised it by exactly 30 cents on both the low and high end.
Which proves the point perfectly.
It proves that essentially the entire guidance raise is just the tariff refund money trickling down to the bottom line minus some conservative padding.
Precisely. They are maintaining a very steady, cautious outlook for the core business. They still expect plumbing to be up low single digits for the year, and they expect the decorative architectural paint segment to be roughly flat.
No huge growth expected.
No. But while the revenue expectations are holding steady, management spent a lot of time warning Wall Street about a significant rising headwind in the second half of the year regarding costs.
Right. We cannot talk about manufacturing without talking about raw materials and commodity inflation.
It's the cost of doing business.
Exactly. Management was explicitly clear that they expect mid-single-digit commodity inflation in the back half of 2026. They specifically highlighted three massive inputs that are seeing aggressive upward price pressure: copper, metals, and oil.
And those three commodities are the absolute lifeblood of Masco's physical supply chain. Let's look at copper and metals first.
Let's do it.
Copper is so tied to the global industrial economy that economists call it Dr. Copper, because its price movements can literally diagnose the health of the global economy.
Right. If everyone is building, copper goes up.
Exactly. Right now, copper prices are surging, driven by massive demand from the electric vehicle sector and green energy grid upgrades. But Masco doesn't make EVs. They make brass faucets and shower heads for Delta and Hansgrohe.
But they still have to compete for the same copper.
Exactly. As global copper demand spikes, Masco's fundamental manufacturing costs skyrocket.
And then you have oil. Why does a home improvement company care about oil? Because oil is the foundational building block for the decorative architectural segment.
Paint.
Right. Modern paint is heavily reliant on petroleum-based chemical resins and inputs. Furthermore, paint is heavy. It is essentially liquid mass.
It's terrible to ship.
The diesel and transportation costs required to ship millions of gallon buckets of Behr paint from a manufacturing facility to a Home Depot shelf are astronomical. When oil goes up, every single gallon of paint becomes significantly more expensive to produce and deliver.
Which naturally brings us to the concept of pricing power. An analyst from Jefferies asked what was perhaps the most vital question of the call regarding the macroeconomic environment.
What did they ask?
For the past 3 or 4 years, companies across every sector have relied on a simple playbook to combat inflation. Just raise the price on the consumer.
We've all felt that at the grocery store.
We absolutely have. But as we discussed with the K-shaped economy and the struggling DIYer, the consumer is exhausted. We are seeing massive pricing fatigue.
Right.
The analysts wanted to know, can Masco really just keep jacking up the price of a shower head every time the cost of copper goes up?
Yeah, will the consumer just snap and stop buying completely?
Exactly. John Nudi's response was very measured, and it highlighted a real shift in corporate strategy.
What's the new strategy?
He noted that on an underlying basis, their pricing is currently holding consistent with expectations. Plumbing pricing is up low single digits, paint is up low single digits. But he heavily emphasized that they are working aggressively to limit the amount of price increases they have to pass on to the consumer.
Okay, so how do they offset the cost then?
Instead of just blindly raising prices, they are trying to optimize their manufacturing footprint, restructure their right. This strategy revolves around a crucial financial concept they call price-cost neutrality. They discuss this specifically in relation to their massive partnership with Home Depot.
Okay, explain price-cost neutrality for us.
The goal in the paint segment right now is not to expand profit margins by gouging the customer. The goal is simply to maintain neutrality in absolute dollars.
Give me an example.
Let's say the petroleum and chemical inputs for a bucket of paint go up by $1. Masco only wants to raise the retail price of that bucket by exactly $1. Their absolute profit dollars remain exactly the same.
Okay, but mathematically, because the total revenue number got larger, while the profit dollars stayed the same, their percentage margin slightly compresses.
Exactly. But management is willing to accept slight percentage compression to maintain dollar neutrality without alienating Home Depot or completely crushing the remaining DIY consumers.
It's a delicate balance.
Very. They expect the paint segment to be price-cost neutral for the year, while they believe plumbing can actually remain price-cost positive.
But there is a massive wild card hovering over all of these cost projections, and it brings us full circle back to the government. Tariffs.
Oh boy, the tariffs.
The geopolitical trade environment is incredibly volatile right now. CFO Rick Westenberg specifically noted that their current cost guidance includes the impacts of the Section 232 tariffs on copper, steel, and aluminum, as well as the newly implemented Section 301 tariffs that just replaced the expiring Section 122 tariffs.
It is an absolute alphabet soup of international trade policy.
Seriously. But what is vital for a retail investor to understand here is the mechanics of the supply chain, specifically the lag effect.
Right, the lag effect is huge.
Westenberg explained that there is effectively a 1 to 2 quarter lag between when a new tariff policy is announced in Washington, D.C., and when the financial impact of that tariff actually hits Masco's profit and loss statement.
Yeah, explain the mechanics of that lag, because it is crucial for understanding how manufacturing accounting works.
It basically comes down to inventory cycles. Masco doesn't buy a sheet of raw metal on Monday and sell a finished faucet on Friday.
No, it takes months.
Exactly. They purchase raw materials globally. Those materials sit in transit, then they sit in raw inventory at a factory. They are eventually manufactured into a product, which then sits in finished goods inventory in a massive warehouse before finally being shipped to a retailer and sold.
It's a massive pipeline.
By the time the product is sold and the cost is recognized on the income statement, the raw materials were likely purchased 3 to 6 months prior. Therefore, the faucets they are selling today were built using copper purchased under whatever the tariff regime was half a year ago.
Which means that if the government announces a massive new tariff on imported metals tomorrow, it won't actually hurt Masco's earnings for another 6 months.
Exactly. This lag effect is exactly why Westenberg expressed confidence that any new unexpected tariffs announced later this year would likely have an insignificant impact on their 2026 results. The pain or potential benefit would naturally roll over into their 2027 financials.
Precisely. However, while the earnings impact is delayed, the cash flow impact of tariffs is immediate and severe.
Oh, because you have to pay them at the border.
Exactly. And this brings us to a critical metric that an analyst from Goldman Sachs, Susan McClary, drilled into. Working capital.
Okay, working capital, that's a big one.
Working capital is essentially the liquidity a company has tied up in its day-to-day operations. It's the cash trapped in inventory sitting in warehouses, or the money tied up in accounts receivable that customers haven't paid yet. Masco ended the quarter with their working capital sitting at an elevated 19.8% of sales.
19.8. And McClary wanted to know why so much of their cash was suddenly trapped.
Yes. And Westenberg pointed the finger directly at the tariff environment. When you have higher tariffs and rising commodity costs, you are forced to pay more upfront for your raw inputs.
That makes sense.
That means every single piece of metal or chemical sitting in your warehouse is literally more expensive, tying up a larger percentage of your available cash.
Furthermore, there is a structural cash flow mismatch with tariffs. When you buy goods from a traditional supplier, you might have net 60 or net 90-day payment terms, giving you time to sell the product before you have to pay the bill.
Right, you get breathing room.
But the government does not offer generous payment terms on tariffs at the port of entry. The payment terms for tariffs are significantly shorter, so Masco has to lay out massive amounts of physical cash much faster to clear customs, which aggressively drains their short-term liquidity and spikes their working capital ratio.
Despite this heavy drain on liquidity, management projected that they expect working capital to normalize and trend back down to approximately 16.5% of sales by the end of the year.
Which honestly just reiterates the operational discipline of this team. I mean, they are managing a highly complex global supply chain through incredible geopolitical noise, commodity inflation, and a fractured consumer base, and they are still maintaining a fortress balance sheet.
It's impressive, which perfectly sets us up for the final synthesis.
Yes, let's wrap this up.
We have unpacked the data, we have looked at the mechanisms driving the numbers, and now we need to deliver the bottom line. What does all of this actually mean for you, the retail investor, as you look at your portfolio?
I am ready for the verdict. We have dissected the 26% EPS beat versus the 3% volume drop. We have explored the K-shaped consumer, the secret defensive investments in plumbing, the billion-dollar buyback machine, and the looming headwinds of copper, oil, and tariffs. So what is our opinionated, actionable bottom line on Masco's Q2 2026?
The bottom line requires holding two conflicting truths at the exact same time.
Okay.
Operationally, Q2 was structurally soft. The core fundamental business of manufacturing and selling physical units of plumbing and paint is facing very real heavy headwinds due to the exhaustion of the DIY middle class and a structurally impaired Chinese real estate market.
That's truth number one.
Right. But financially, the quarter was a masterpiece. It was incredibly strong because of aggressive elite capital allocation by management and the fortunate timing of a $95 million government windfall.
It is the ultimate tale of two realities. The physical reality of moving boxes off a shelf is difficult right now, but the financial reality of managing the spreadsheet and maximizing shareholder value is brilliant.
Exactly.
So let's make this highly actionable. What do you actually do with this stock? Let's start with the current holders. If I already own shares of MAS, how should I feel after spending an hour analyzing this call?
If you are currently holding Mascoga, you have to be thrilled with this management team. They are proving that they can operate defensively and profitably in a very soft macroeconomic environment.
They really are.
They are keeping their margins historically high. They are utilizing targeted revenue management to offset inflation without destroying their retail partnerships. And most importantly, they are aggressively shrinking the share count to manufacture EPS growth.
That billion-dollar target for share repurchases and acquisitions is the key. As a current holder, knowing that the company itself is actively in the open market, ready to deploy $1 billion to buy up its own stock, provides a massive floor under the share price.
It's a huge safety net.
Even if the housing market stays sluggish and interest rates remain high for another year, management is engineering profitability through buybacks. It is a highly defensive posture, but an incredibly profitable one for existing shareholders.
Exactly. You are being paid to wait for the housing market to recover.
But our advice shifts significantly if we look at this from the perspective of a prospective buyer, right?
It absolutely does.
Okay.
If you are sitting on the sidelines with fresh capital, looking to initiate a brand new position in Masco today, I would strongly advise caution.
Why is that? I mean, if the management team is so good, why not buy in now?
Because the long-term top-line growth narrative of this stock relies heavily on a broader housing and repair and remodel rebound that simply has not materialized yet.
Right.
On the call, management repeatedly noted that the long-term macroeconomic drivers are firmly in place. Americans have record levels of home equity, the national housing stock is aging rapidly and needs repair, and there is massive pent-up demand.
People want to renovate.
They do, but those are long-term secular trends that could take years to unlock. In the immediate short term, the K-shaped economy is punishing the bottom half, and the DIY consumer is clearly tapped out.
And when you add in those second half commodity price hikes in copper and oil, it could start to squeeze the very 24% margins they just bragged about, especially once the one-time $95 million benefit of the tariff refund is fully in the rearview mirror and can no longer be used as a smokescreen.
That's exactly right.
The financial engineering and the massive buybacks are a fantastic bridge over troubled waters, but eventually, to have sustained explosive stock growth, you actually have to sell more paint and more faucets to more people. You need physical volume to return. And right now, the volume just isn't there.
Exactly. If you buy Masco today, you are buying a world-class management team, but you are buying them while they are operating in a very tough, constrained neighborhood.
Which brings us to our final thought. I want to leave you, the listener, with a broader, slightly provocative macroeconomic concept to mull over as you analyze the rest of your portfolio this earnings season.
It's a great thought experiment.
We spent a lot of time on this show dissecting single companies, but massive corporations like Masco act as highly sensitive macroeconomic sensors.
Yeah.
Their internal sales data often tells us what is actually happening on the ground long before the government releases official inflation or GDP metrics.
And the single most glaring data point that stands out from Masco's entire report is that high single-digit decline in DIY paint sales.
Exactly. Paint is historically one of the absolute cheapest, easiest, and most accessible ways for a homeowner to update their living space. It requires very little skill and minimal capital.
Anyone can do it.
Right. If the American middle-class homeowner is actively putting off buying a $30 can of Burr paint and a $10 roller, what else are they putting off?
It raises a fascinating structural question about the future of the consumer economy. Are we transitioning entirely and perhaps permanently to a do-it-for-me economy?
Do it for me.
Yeah, an economy where only the wealthier demographic, the upper arm of the K, the people who hire professional contractors for full renovations and buy luxury saunas for their backyards, are the ones driving all discretionary spending.
Or is the middle-class homeowner simply in a temporary state of paralysis? Are they fundamentally tapped out by the cumulative compounding effects of 3 years of inflation, just waiting for the Federal Reserve to drop interest rates or for wages to finally catch up before they tackle the Saturday morning honey-do list?
It's the big question.
It is a crucial dynamic for you to investigate as you look at other retail, consumer discretionary, and home improvement stocks this earnings season. When companies like Home Depot or Lowe's report their earnings in the coming weeks, you are going to want to look very, very closely at their DIY versus pro revenue breakdowns. Masco just provided us with the canary in the coal mine.
A very profitable canary thanks to some elite financial engineering and capital allocation, but a glaring macroeconomic warning signal nonetheless.
Absolutely. Thank you for tuning in to this data-packed deep dive. We took you from the headline numbers all the way down to the bottom of the supply chain to see how the gears of this economy are actually turning. Keep your eyes on the data, watch those commodity prices closely, and we'll catch you on the next one.